Hi there, thanks for tuning in. So today is the third episode in our series where we are exploring the income statement and breaking it down line by line. The item we're going to talk about today is gross profits, also known as gross income. Both terms are used interchangeably. To understand gross profit, you should watch the two videos before this one that explain revenue and the cost of goods sold or cost of revenue. Gross profit is what you get when you get revenue and then subtract the cost of goods sold or the cost of revenue from it. The resulting number can tell us how efficiently a company is producing its goods and services. If a lot of the revenue is getting absorbed into the cost of revenue, then the company maybe isn't being the most efficient. Or if a lot of the revenue ends up being passed through the gross profit, then maybe the company is incredibly efficient at producing goods and services. Maybe they have figured out how to do it at a much lower cost and thus can create a lot of gross profits. It's important to note that because the cost of revenue does not usually include some other costs, such as, for example, fixed costs or payments to management, gross profit does not give the entire picture, but will tell you how efficiently companies are managing their variable costs. And from gross profit, we can get an incredibly important ratio called the gross profit margin. To get the gross profit margin, all you have to do is get the revenue minus the cost of goods sold and divide the resulting number by the revenue. This will give you a total percentage, which is what percentage of the revenue is getting passed on to the gross profit. The higher the margin is, the more efficient a company will be at generating revenue for each dollar of cost it has. But when you're looking at the gross profit margin, it's very important to not look at it as an isolated number. The gross profit margin represents one given point in time. So if I have a margin for the fiscal year 2021, well, I may want to compare it to the margin in fiscal year 2020, 2019, 2018, and so on, because the rate of change can be something very important to tell the overall direction of the company's efficiency and how efficient they're becoming, or if they're becoming less efficient over time. That is to say, if a company's gross profit margin is 50%, but last year or the years before it, it was more in the 55 to 60 range, then they are losing some of that operating efficiency that they may have had before. There are multiple reasons why this may happen. One of them, for example, could be inflation. If they have materials that they have to buy to manufacture products, and those materials are all of a sudden more expensive, and they don't find a way to make it more efficient, then their gross profit margins are going to take a hit. And the reverse is also true. As a company gets more efficient and starts knowing how to manufacture or create its goods and services more efficiently, it can also increase those gross profit margins. So remember, this represents a period of time. And if you're forecasting gross profit margins into the future, then it may be important to consider the changing landscapes. Either the company is getting more efficient or less efficient, or if the company itself is doing the same things, maybe there is inflation or deflation, which could change the picture of the margins. And depending on the industry, the margins themselves may look a little different. For example, if there's a software company you're analyzing, maybe they already developed the software, so a lot of their costs are just maintenance and maybe marketing, and their margins may be way higher than, for example, a manufacturing company that may depend on the price of the materials they're using and may be more exposed to fluctuations in prices that they don't necessarily control. So some industries will naturally have higher gross profit margins than others. So just for a quick review, gross profits is simply revenue minus the cost of revenue or the cost of goods sold. And then to get the gross profit margin, you essentially get the gross profit and divide it by the revenue. This will help you understand how efficiently a company is handling its variable costs and creating revenue from every dollar of cost of revenue. So with that said, I thank you so much for watching. If you would like to see more videos like this, please stay tuned. There's still a lot of items to go on the income statement. Remember to subscribe and hit the notification button, and also drop a like if you want. It really helps with the YouTube algorithm. So with that said, I thank you so much for your time, and I hope you have an excellent day.